Crypto exchange Coinbase selling about $2 billion worth of debt via junk bonds, up from an initial target of about $1.5 billion due to some strong market interest. Now, the move highlights crypto's evolution from a fringe asset class to one under the spotlight in mainstream finance. And joining me now to discuss is John D'Agostino, head of strategic partnerships at Coinbase Institutional. Welcome to the show, John. So we're reading about this latest news, junk bonds at 7 to 10-year bonds sold at interest rates of between 3.4 to 3.6%. There seems to be a lot of demand, and I wonder, where is this coming from?
Well, I think we're now seeing what's been talked about for a number of years, the broad-based, both retail and institutional acceptance on a global basis, not just U.S., of not just Bitcoin, but this entire asset class, Bitcoin being the bellwether entity, obviously. But we've been hearing stories about institutional waves of capital coming in for some time, and it's being realized at, again, both a retail level and a institutional allocator level.
Now, that is a theme definitely at the SALT conference. We're seeing a lot of hedge funds, PE firms, capital allocators talking about crypto. If you walk down these halls, a lot of crypto companies, names like FTX, Circle, Solana, just to name a few, NYDIG, having huge booths. So when your conversations at the conference, what are hedge fund managers, allocators asking you about?
Sure. It shouldn't surprise anyone that actively managed closed-ended, open-ended funds, hedge funds, private equity, VC, anyone who takes in people's money and wants to make more money out of it are constantly searching for new sources of alpha. We know that over the last 11 to 15 years, there's been a degradation of alpha in those traditional asset classes. We have the numbers, we have the performance on an annual basis, and so when you have new markets, new asset classes, new mechanisms, new ways of trading, whether it's the origins of high-frequency trading, 8 years ago, 9 years ago, opening up new markets abroad, or entirely new asset classes like we have with the digital asset ecosystem, it's not only entirely predictable, it should be expected that those who are paid to produce alpha would research and search out those opportunities. So it's just a matter of that infrastructure being ready to accept institutional quality capital, regulated capital. And now that it's here, because of companies like Coinbase, it's an institutionally acceptable asset class, and it's perfectly normal that they would experiment with it and start to engage fully.
So are you getting a sense, are they in the stage of just exploration, or are they ready to write checks? And if so, what kind of allocations are they making?
Again, in general, take a typical hedge fund. Usually the documents allow for anywhere from 1 to under 5% outside of the core mandate, right? So a hedge fund that's an equity long short hedge fund, for example, would be generally allowed to trade under 5% in credit, for example, without having to go back to their investors and say, we've altered our mandate. So that's a good range for what we call experimentation. Coming in at at less than 1% allocation usually isn't worth the time it takes to sign up the new accounts and whatnot. And then over 5% generally, if that's not in your documentation, you have to go back to your investors and say. So that's about a expected range. And then once they get comfortable with the asset class, they can make a decision. Do we want to increase exposure and then get permission from our investors if our documents require that, or maybe launch an entirely new fund vehicle? Again, and both of those we're seeing more and more often.
I wonder, what kind of client is your typical client? And we've heard some news, PNC, MicroStrategy, and they just this week bought 5,050 new Bitcoin. So what does a typical client look like?
So here's the great thing. Here's how you know the asset class is becoming truly institutional, because there isn't a good answer to that question. What I mean by that is there's a difference in market liquidity, and that's my expertise. Coinbase brought me in because I know exchanges. I was head of strategy for the New York Mercantile Exchange, and I saw that asset class go from not institutionally acceptable to institutionally acceptable over multiple decades. Cryptocurrencies have truncated that acceptance range into less than a decade. And so what I mean by there not being a right answer is, if you have a market that is deep but not broad, meaning there's lots of volume, but you don't have a diversity of participants. There's one type of participant. That's problematic. So if I were able to answer that question easily and say a median cryptocurrency investor is XYZ, I think you would be able to discern that we have a problem with the underlying depth and breadth and liquidity. The best answer to that question is it varies. It ranges from original OG cryptocurrency whales. It ranges to looky-loos who come in and just want to experiment in the asset class. It's individuals who are Bitcoin maximalists who are very excited about the deflationary aspect of the currency. It's people who want to experiment in the asset space. It's people who are approaching it on a market neutral basis. It's hedgers, it's speculators, it's commercials, it's retail, it's institutional. That is what we're seeing now. And that is a true broad and deep market that is both institutionally acceptable, and then the offshoot of that is it's better for the retail market because it's less prone to massive gaps up and gaps down.
Right. And are you offering them Bitcoin or other altcoins?
So I'll get this wrong and get fired probably, but it's many coins. I think it's about 240 coins at one point, but please don't hold me to that. Go to our website and take a look because it's being updated all the time. But again, it's about depth and breadth. It's about offering a diversity of options for both institutional and retail investors.
Right. I would be remiss not to mention this, but obviously Coinbase CEO Brian Armstrong has mentioned very publicly his dismay over the regulatory environment in crypto right now, saying that the SEC hasn't been very forthcoming in some of their positions regarding a yield product that Coinbase is offering. They want to offer lending at a 4% annual percentage yield. They've been given a Wells notice, which is an intent to sue, and they're saying that they haven't been given a thorough explanation as to why they've been given this notice. And I wonder, does that have any impact on the institutional side?
So the short answer is the institutional side is growing. It's growing rapidly. Exchanges are essential parts of critical economic infrastructure. After 9/11 in New York City, two of the businesses that were rushed to open first were the New York Stock Exchange and the New York Mercantile Exchange. So it's natural that as exchanges grow, they will be working very closely with government and with regulators to make that happen. And the technology usually leads ahead of the regulation, and that'll be a dialogue. And to answer your question specifically, it has not slowed down or hurt the institutional outreach around the launch of Prime. I think those are very separate issues, and that's one is a natural evolution and discussion, and the other is the introduction of a product that is desperately needed right now to a market that's hungry for that product.
Hungry for that product. And I have a bit of more of a philosophical question for you, if I may.
Please.
There are a lot of great products being offered to access this financial system, this digital financial system. And there is potentially a bit of frustration that it may not be accessible to retail investors that have the knowledge to be able to understand these products. What are your thoughts on a knowledge-based access to these products versus a wealth-based access to these products?
That's a great question. Now, this is my personal opinion. I'm not speaking on behalf of Coinbase at all. We have different models, right? In Europe, there's a knowledge-based or an opt-in, opt-out model. Effectively, what you're doing when you opt in to being treated like a sophisticated investor is you're opting out of certain legal protections, right? The bar is higher to sue. The bar is higher to get recourse when you're considered a sophisticated investor. So I think it's the will of the people. We live in a country that's decided to go in the direction of wealth. Now, it's pretty clear from certain moves that the SEC has made that they seem open to the idea of some type of hybrid model because we had an expansion of the accredited investor rule. But I think that's a congressional issue. We have to decide what type of country we want to live in. We've chosen to go in one direction. I think we're the envy of the world to some degree in terms of investor protection. So I think that's it'll be decided amongst voting into Congress and then Congress informing the SEC. But I think the hybrid model seems to be a reasonable one. Wealth is an indicator that you can lose a certain amount of money without it hurting you or hurting the economy. And then also clearly knowledge and sophistication should play some role in that.
We'll see how it rolls out as the regulations.
I can tell you this, that countries that have one or the other, no one has a perfect model. The folks that the countries that have purely knowledge-based model have issues as well. So I don't think there's any one right answer to this.